Welcome to today's practical planning tip by ParkBridge Wealth Management. My name is Jonathan Shankman, and I'm the President and Chief Investment Officer of the firm. Today, I'd like to continue our series on the topic of retirement and falling interest rates, specifically focusing on what to avoid. First, avoid reaching for yield. Over the past few years, investors have enjoyed putting their cash in money market funds and collecting attractive yields with virtually no risk. However, as rates come down, these risk-free rates will also fall. While searching for higher yielding investments, investors may subject their money to volatility and possibly the loss of principal. Focusing on the yield of investment at the expense of all other due diligence will have an unfortunate ripple effect on the rest of one's finances. Money that folks need for near-term expenses or a rainy day fund should still sit in cash or cash equivalents despite of more modest yield. Next, avoid pursuing lower quality credit. Investors may be enticed by lower quality credit to maintain a certain yield within their fixed income allocation. Unfortunately, that means investing in companies with shakier balance sheets. This may be fine for a small portion of one's portfolio. However, substituting most of your fixed income to obtain a higher yield is ill-advised. As I frequently remind my clients that clients risk and return are inextricably linked. If you want higher yields in a low interest rate environment, you need to be willing to take more risk with your capital. It's important to keep in mind that the ultimate role of high quality bonds in one's portfolio is to serve as a ballast against more volatile equity positions. Once you invest in lower quality companies, those diversification benefits and the margin of safety are gone. You should also avoid extending duration. Another way for investors to maintain a targeted yield within their portfolios by extending the duration on fixed income holdings. In other words, instead of going out 1 or 2 years on their yield curve, they instead could go out 1 or 2 decades or longer. The challenge is that duration is a measure of bonds price sensitivity to interest rates expressed in years. Therefore, a bond with a higher duration is more sensitive to interest rate fluctuation. Its price will change more significantly for a given change in interest rates than the price of a lower duration bond. For example, a bond with a 10-year duration is expected to lose approximately 10% of its value if interest rates rise by 1%, whereas a short duration bond would be expected to lose only about 1% of its value. Any unexpected change in interest rate policy can leave bond investments just as volatile as equities. Extending duration on your bonds leads to more portfolio volatility without the upside that equities provide. In my next video, I'm going to share some final thoughts for retirees when interest rates are low. And with that, I hope you found this practical planning tip helpful. Until next time, stay prudent and practical, and don't forget to plan ahead.